In a world where most people live trapped between debt, impulsive spending, and a barely there income, there is a small group of people who have achieved something that for many seems unattainable: true financial freedom. I'm not talking about millionaires who spend recklessly, but about individuals who understand the invisible laws that govern money and apply them with the precision of a watchmaker. These people know that wealth is not measured by what you buy, but by what you are able to keep and grow. They understand that every coin has a destiny to multiply or disappear, and the choice is always in your hands. Today, we're going to explore 10 powerful strategies that can transform the way you view and use money. These aren't just tips, they're principles that have guided some of the world's most successful investors, entrepreneurs, and strategists. As you listen, ask yourself, how many of these principles do I already live by, and how many do I need to adopt today? And before we dive into this journey, I want you to write in the comments, almost like a personal declaration, "I attract abundance with intelligence." It's not just a phrase, it's a reminder that wealth begins in your mind before it begins in your wallet. Strategy 1: the power of paying for knowledge rather than objects. Most people grow up believing that money is meant to be spent on things you see, touch, and show off. A new car, the latest phone, seasonal clothes. But the truly rich are those who build silent and lasting wealth because they understand something that almost no one applies. Knowledge is the asset with the highest return there is. Investing in learning is not the same as paying for an expensive college degree that you may never use. We're talking about specific skills with high market value: negotiation, investing, sales, programming, project management, leadership. Skills that allow you to multiply your income-generating capacity indefinitely. Think of it this way: if you invest $500 in a negotiation course, and that skill helps you close a deal that will net you $50,000 in the future, your return on investment wasn't 100% or 500%, but 9,900%. On the other hand, if that $500 is spent on a pair of trendy shoes, the real value disappears within weeks, and they'll likely end up forgotten in your closet. The data backs up this idea. According to the Association for Talent Development, professional training can increase a person's annual income by up to 25%. And when we project this over a 10-year career, the difference isn't just noticeable, it's huge. We're talking hundreds of thousands of extra dollars simply from acquiring focused and useful knowledge. A new car loses on average 20% of its value in the first year and up to 50% within 5 years, according to Kelley Blue Book. A $20 book or a $200 lecture doesn't lose value. It stays with you, multiplies, and continues to bear fruit every time you apply what you've learned. So, before you spend, ask yourself, will this purchase make me more money or just give me a moment of pleasure? Those who understand this question begin to invest in courses, mentorship, experiences, and environments that expand their minds, not in objects that just take up space. Strategy 2: absolute control over invisible spending. It's not the big purchases that destroy your ability to accumulate capital, it's the money that slips away without you noticing. The small leaks, the automatic payments, the subscriptions you forgot to cancel, the daily coffee that only costs $3 but turns into $1,095 a year. A report by Mint.com revealed that the average American spends more than $5,000 a year on invisible purchases, recurring payments, and impulse purchases, so small they're barely remembered. If that money were invested in an index fund with an average annual return of 8%, in 10 years, it would grow to more than $72,000. That's no small feat. The consciously wealthy review every bank statement with the precision of a surgeon. They don't do it out of obsession or greed, but because they know that every dollar not wasted is a soldier who can go into battle to generate more wealth. They understand that it's not what you earn that makes you rich, it's what you keep and multiply. This check isn't a one-time event, it's a monthly ritual.
Spending is reviewed, unused subscriptions are canceled, bank fees are negotiated, and cheaper alternatives are sought without sacrificing quality. Ultimately, the goal is for every expense to be a conscious decision, not an automatic leak. Imagine your bank account like a bucket. It doesn't matter how much you pour in if it's full of holes. Plugging those invisible leaks not only preserves your capital, but accelerates your financial freedom.
Strategy 3. Escape the easy credit trap. Easy credit is like poisoned candy. It looks attractive, promises immediate satisfaction, but over time, it comes at a steep price. Financial institutions know this, which is why they offer credit cards and personal loans with rates that, in some countries, exceed 30% or even 40% annually. That percentage means that if you owe $10,000 and only pay the minimum, you could end up paying more than double that amount in a few years and still be in debt. Imagine buying a state-of-the-art television for $1,200 with your credit card, with an annual rate of 32% and only paying the minimum monthly payment. In 4 years, that television, which would be old and obsolete today, could have cost you more than $2,000. That's paying more for something that is worth less every day. Millionaires and successful entrepreneurs use credit in a completely different way. They don't use it to acquire whims, but to finance opportunities that generate income greater than the interest cost. A clear example is buying a commercial space with financing, but from the first month onwards, it generates rent that covers the installment and leaves a profit. The rule is clear and admits no exceptions. If what you buy with credit doesn't generate income, you're mortgaging your future. Credit isn't bad in itself. What's dangerous is using it without a strategy, because it turns people with good salaries into prisoners of their own expenses. If you want to escape this trap, first eliminate your most expensive debts, even if they're small. Then establish an emergency fund that prevents you from resorting to credit for any unforeseen event. Financial freedom begins the day interest stops working against you and starts working in your favor. Strategy 4. The law of the asset that works while you sleep. Working more hours isn't always the solution to earning more money. In fact, the richest people in the world don't measure their wealth by the hours they work, but by the income they receive even when they're doing nothing. This is the principle of passive income, money that comes into your account without requiring your constant time. The clearest examples are property income, stock dividends, book or music royalties, and businesses that operate without your physical presence. If you manage to build a solid base of assets that produce a steady flow, you'll work less and earn more each year. To understand this better, imagine you have $100,000 invested in a mutual fund that earns 8% annually. That's $8,000 a year without lifting a finger, which is equivalent to about $666 a month. It's not a figure that will make you a millionaire immediately, but it does show the potential. If you reinvest those earnings and continue contributing capital, in 10 years, you could be receiving more than $20,000 a year from compound interest alone. This is the true luxury of life, not an expensive car or a designer watch, but the freedom to decide what to do with your time because your income doesn't depend on your presence in an office. The problem is that most people want immediate results, but building assets requires patience and a long-term vision. A famous saying goes, "If you don't find a way to make money while you sleep, you'll work until you die." Therefore, every dollar you receive and don't need to live should be a soldier you put to work for you, instead of leaving it idle or spending it on things that depreciate. Remember, it's not just about earning more, but about making what you earn continue to generate more, even when you're not working. Write in the comments, "I accept success and happiness in my life," so that this principle becomes engraved in your mind and you can turn it into a personal goal. Strategy 5. Buy value, not price. The most costly mistake most people make isn't spending too much, but spending poorly. They confuse saving with paying less, when in reality, true savings are paying once for something that lasts and adds value. rather than paying many times for something cheap that deteriorates. This mentality applies not only to material goods, but also to investments and personal development. In the financial world, buying value means acquiring assets with solid fundamentals, even if they don't seem like a bargain at first glance. For example, if you buy shares in a company with a history of consistent growth and a dominant market position, paying a slightly higher price can be a master move. Warren Buffett, one of the most successful investors in history, always says, "It is better to buy a wonderful company at a fair price than a fair company at a wonderful price." In everyday life, this principle is just as powerful. An appliance that costs $1,000 and lasts 10 years, performing flawlessly, is actually cheaper than a $300 appliance that you have to replace every 2 years. The same goes for clothing, work tools, and education. Quality isn't just paid for, it pays off and multiplies. The problem is that cheapness often comes with a hidden cost: your time, peace of mind, and money in the long run. The temptation to take advantage of a deal can be the gateway to a cycle of repeat purchases, frustration, and waste. However, when you learn to assess the true value of things, the durability, usefulness, impact, and return, each purchase becomes an investment. Even your personal training follows this rule. Paying for a quality course that gives you skills that will generate income for years is infinitely more cost-effective than saving on training and spending years learning by trial and error. An investment in knowledge and the right tools pays for itself many times over. If you internalize this principle, you'll notice that your finances become more solid and that money stops escaping in invisible leaks. Buying value, not price, is one of the wisest decisions you can make to build sustainable wealth. Strategy 6. Resist lifestyle inflation. Imagine that for years you struggle to earn more, but when you do, your expenses grow at the same rate as your income. This phenomenon is called lifestyle inflation and is one of the silent killers of wealth. Most people don't realize that what holds them back isn't what they earn, but what they spend relative to what they earn. If your income increased by 50% today and you decided to maintain your standard of living, saving and investing that surplus, in 5 years you could accumulate significant capital, enough to change your life. For example, if you currently earn $2,000 per month and save $500, by increasing your income to $3,000 and keeping your expenses at $1,500, you could save $1,500 per month. In just 5 years, you would have $90,000, not including returns. Investing that money at 8% per year would earn you over $130,000. The problem is that psychologically, as income grows, so do temptations. A more luxurious car, designer clothes, more expensive dinners, more frequent trips. And while these things can be pleasurable, they become burdens if not accompanied by a solid investment plan. Financially savvy people practice moderation even in their best financial times. They don't deprive themselves of enjoyment, but they understand that true luxury isn't higher spending, but the freedom to choose what to do with their time. Maintaining a healthy margin between income and expenses creates a safety zone that protects your peace of mind and accelerates your path to financial independence. Instead of letting your lifestyle balloon, redirect every increase in income into assets that generate more income. That way, in just a few years, the income from your investments will be able to cover your expenses, and every cent you earn will be extra. This is when your money really starts working for you. The real challenge isn't resisting the temptation to spend, but staying focused on your long-term vision. If you remember that your future is worth more than any momentary gratification, it will be much easier to keep your finances under control. Write in the comments, "I am prosperous and I attract wealth," to remind yourself every day that your financial growth depends more on your discipline than on the amount of money that comes into your account. Strategy 7. Detect and act on invisible opportunities.
The great paradox of opportunities is that they almost never present themselves with a bright sign saying, "Here's the key to your success." On the contrary, they are usually disguised as problems, risks, or even temporary losses. That's why 90% of people ignore them, while the 10% who know how to identify them end up capitalizing on what others ignored. In the financial world, this also happens with companies in crisis. A stock that everyone sells out of fear can be the same one that, in the hands of someone patient, becomes a capital multiplier. A historical example? Apple was nearly bankrupt in the 1990s. Today, those who bought at that time have multiplied their investment more than 300 times. The secret to detecting invisible opportunities lies in training your financial radar, reading trends, analyzing cold data, and not letting collective panic cloud your judgment. While the average person reacts to the news, investors prepare before it arrives. But be careful, it's not about jumping in without calculation. Action must be swift, but supported by numbers and clear strategies. It's a balance between trained intuition and solid analysis. When you learn to see what others don't see, you stop competing for the obvious and start investing in the inevitable. That's where the real money game is won, long before anyone else even realizes there was a game. Strategy 8. Protecting capital like a sacred treasure. Making money is exciting, but preserving it is an art. Elite investors have a golden rule. The priority isn't how much you earn, but how much you manage to preserve over time. Because every loss is a deep wound that takes much longer to heal than it took to open. Think of it this way. If you lose 10% of your capital, you need to earn 11% to get back to square one. If you lose 50%, the mountain becomes almost impossible. You need a 100% profit to recover. This simple calculation is what separates emotional gamblers from true financial strategists. Millionaires don't risk the core of their wealth. They diversify, protect with insurance, invest only in what they understand, and never bet essentials for optionalities. They prefer steady, moderate growth to a risky bet that could destroy years of work. This doesn't mean being overly conservative. It means having a financial shield that allows them to continue growing even in times of crisis. Those who survive the storms aren't always the fastest, but rather those who know how to protect their ship when the big waves hit. We saw a clear example in the 2008 crisis. Those who had diversified investments in real estate, solid stocks, and cash reserves not only protected their capital, but also took advantage of the opportunity to buy assets at discounted prices. While others were drowning, they were fishing in calm waters. The right mindset is to treat each dollar like a soldier. You don't want to send your soldiers into battle unprepared. You want them to work for you, come back, and bring more soldiers, not disappear in the first fight. Write in the comments, "I accept success, money, and happiness in my life" if you decide that your wealth will be defended with the same discipline with which a guardian protects his most precious treasure.
Strategy 9. Keep your mind richer than your bank account. Money is like water in a container. If the container is broken, no matter how much you fill it, it will always empty. The mind is that container. If your mindset is limited, disordered, or fearful, any income you receive will vanish. That's why truly prosperous people first invest in strengthening their ability to think, decide, and adapt. Millionaires understand that the most powerful wealth is not measured in dollars or euros, but in skills, knowledge, and connections. Financial capital can be lost due to an economic crisis, but strong mental capital allows you to rebuild it again and again. If all your money were taken from you today, but you kept your mind trained, you could start over and go even further. Financial education, emotional intelligence, the ability to sell, negotiate, and solve problems are invisible assets that multiply everything they touch. That's why wealthy people pay for courses, hire mentors, read compulsively, and travel to learn.
They don't see this as an expense, but rather as the best investment there is, one that never loses value and, in fact, appreciates over time. It's a mistake to think, I'll make money first, then I'll learn. The reality is that you learn first, then you make money. And the more you learn, the more money you can generate and retain. This doesn't just apply to technical knowledge, but also to how to manage your emotions when markets are down, how to make quick decisions, and how to spot opportunities before everyone else. Ask yourself a key question. If your bank account were to be at zero tomorrow, what skills do you have to rebuild it? If the answer makes you uncomfortable, there's no shame in that. It's a clear sign that it's time to work more on your mind than on your income. Because when the mind is richer than the bank account, money becomes a frequent guest. And, most importantly, it knows it wants to stay. Strategy 10. Have a 20-year vision. Most people think about their next month. The truly rich think about the next 2 decades. They don't play the money game to win quickly, but to build an empire that grows and sustains itself over time. Imagine that financial life is like planting a forest. Those who think short-term plant flowers, beautiful, quick-growing, but they die within weeks. Those who think long-term plant trees. They take years to grow, but when they do, they provide shade, fruit, and timber for generations. Having a 20-year vision means asking yourself, how much capital do I want to accumulate in 2 decades? What industries do I want to be present in? What lifestyle do I desire? What legacy do I want to leave? This clarity is a powerful filter that allows you to say no to temptations that lead you astray, and yes only to actions that bring you closer to your ultimate goal. Long-term investors often use the rule of compound interest to their advantage. For example, investing $1,000 a month with an 8% annual return doesn't seem like much. Until you project it out over 20 years, it turns into more than $590,000, not counting additional reinvestments. The magic isn't in the initial money, but in consistency and time. The problem is that the human brain is wired to prioritize immediate gratification, which is why so many people sacrifice an abundant future for a slightly more comfortable present. Breaking that pattern is an act of discipline and strategic vision. If you decide today that your financial life will be guided by a 20-year plan, you will be building something that will not only give you wealth, but also peace of mind, purpose, and the ability to say no to what doesn't fit your map. In the end, true wealth isn't just about what you have in your bank account, but what you carry in your mind and heart. Money is a resource that can be multiplied, lost, and recovered. But your mindset is the engine that defines how much of that money reaches you and how much decides to stay. If today you start thinking 20 years ahead, cultivating a mind richer than any number, and making decisions with an eye to the future, I guarantee that your financial life will take a turn that few experience. Not because luck will change, but because you will have changed. Remember that time will pass anyway. The question is, do you want to reach that future with an average life full of what-ifs, or with wealth, freedom, and peace of mind that allow you to enjoy every day without fear of tomorrow? Most will live to pay bills. A few will live to reap the seeds they planted with intelligence and patience. And the difference isn't where you were born or who grew up with you. It's what you decide to do from today on. If something you heard today lit a spark in you, don't let it go out. Take the first step, even if it's small, but take that step.